Hello, good afternoon everyone. Welcome to our budget roundup for 2021. Welcome to those who've attended this before, or attended these sessions before, and also a big welcome to those who are coming along for the first time. Welcome to Tam, my co-host for today. Thanks for the contribution. We've been putting this session together over the last few days, obviously after the announcement, so thanks for your contribution there and for jumping on and agreeing to have a chat. Big thanks also to Amy, who, as always, is sitting in the background, making sure these things sort of go pretty smoothly, or as smoothly as possible, and also who set up the presentation and got all the information out to people to allow you people to come along and have a listen to what we're going to say. So thank you for that, and also to the other staff members and partners who contributed points to this as well, and who we've had various discussions with over the last few days. There's been a bit to get through. So before we get into I suppose the budget discussion, we'll just some quick housekeeping things. So in a minute, we're just going to minimise our video so we can see the screen and see the stuff in the slide, because that's the important things, and we'll come back when we get to the questions at the end. So if we could just put the questions in the chat box to the right hand side, you'll see there. We'll answer those at the end. We won't do that on the way through. So if you have some questions, please feel free to put them in there, and we'll try to deal with them if we can. If you lose your connection to the session, you should just be able to refresh, and it should just load up again, so that'll be fine. You'll receive an email with a copy of this presentation after the session. There will be a copy put onto Facebook as well, as we normally do, and also an information handout will be available. Amy will put that in the handout section. In fact, she's just done that now. So this is a bit of a summary of the points we're covering off in this session, as well as a few more things, probably a bit more extensive information with some of the more obscure points. But if you want to have a look at that, please feel free to have a read through. So before we get into talking about the budget, we just want to give a quick update on where we're at as far as PTP and returning to a somewhat normal post-COVID, I suppose, situation. We're now back into our offices. As with most businesses following COVID and people working from home, we're probably a little bit different now in that there's some of the team working from home, some at the office at various times during the week, mostly in the office, but obviously always contactable as we have been via email, phone, however you normally contact us. Our focus has been moved on now from JobKeeper, and it's obviously JobKeeper finishing at the end of March. That was a fair bit of last year and also the start of this year. And with cash flow boosts and that sort of thing. So whilst it was a far from perfect measure, it did do a really good job of getting money out quite quickly to businesses, and we found it enormously useful, whilst difficult to administer, very useful for most of our clients, and made a real difference. Whilst we know that broadly the economy is recovering quite well, we also understand there are some businesses still struggling out of this COVID thing. So there is a lot of focus on trying to, I suppose, keep the support there. That will always be there, and we also know that people have had various experiences over the last 12-18 months. Some businesses have gone pretty well as normal. Some have gone much better. Some have gone much worse. So it's been a different experience for everybody. I think broadly across the board, though, it has been a tough 12 to 18 months. I think now we're probably more able to move back towards a looking to the future. So as opposed to probably what was more of a week-to-week or month-to-month sort of situation, very difficult to plan last year because none of us really knew where we were going and what was happening. So that was it was difficult, but we're now able to start looking forward, hopefully for this year, for the remainder of this year, and then into hopefully we can keep this normality in place and get some borders open and keep that money flowing. We also know that last year was terribly exhausting for pretty well everyone. It doesn't matter what you do. It was difficult. It was certainly a big eye opener around some of some big holes in I think in key sectors, namely aged care and mental health. And I think the budget's we're not going to cover too much on where the spending's gone, but I think the budget reflects that, and I suppose people just the government being aware that yes, there was some quite large weaknesses and holes that needed to be plugged there. So they've certainly tipped some pretty large funding into that. As Brian and I did last year when we were running these things for JobKeeper on a more regular basis, We'd just like to encourage everyone to reach out and touch base, because whilst we understand that, as I said, we're coming out of this, it is still difficult. And I know for me personally, and I think talking to a few clients as well, probably the realisation for how challenging last year was probably took a couple of months into this year to really hit home. But I think, whilst you're in the middle of it, in the middle of the storm, it's probably, you just have to deal with it. You haven't really got a lot of choice. I think probably once you get out the other side a little bit, it's where it becomes difficult. So please feel free to reach out. We'll help you as much as we can in whatever way we can. That support level is important to us. We'll always be there. So the message from us is still use us to support you to look after yourself and your business. I was driving around the countryside yesterday a little bit talking to clients, and had some time to talk to Tam, as well as business partners, about the budget itself and our general thoughts on it. And pretty well I suppose the PTP view, if I can call it that, on it and how it impacts our budget. I'm not going to get too political here. It's probably more how it impacts small to medium businesses, but it's a bit of a business as usual budget was probably the theme that I got from talking to most people. There's not a lot of new things in there. So there's the two key things that we'll talk about in a minute for business are pretty well extensions of what was already there from the last budget. And really nothing at all that's unexpected or unusual. There's certainly some spending in different places, but as far as the tax concessions and things that are there, it's pretty well what we expected it to be. So today we're going to cover off, I suppose, the budget in terms of business and employers. We're going to talk about the low to medium income tax offset that's been extended, which is a little bit more money in people's pockets. Excuse me, we're going to talk about you and your family, that there's some things around, obviously, childcare subsidy there that are important. Superannuation, there's been some slight changes around that. There has been a little bit of a change around debt recovery with the ATO. Not as relevant as what we thought it might be in the beginning, but it's still there, so we'll mention that. We're going to talk about tax planning briefly at the end of it if we've got some time, and that's probably more just given the time of year. This is the time of year where we're looking to have a look at clients' positions and how they've travelled, whether it's been good or bad, because there's things we can do either way to get a good tax result, I suppose, across the board. So we'll talk about that. We're also going to talk briefly at the end, and Tam will talk about her business mentoring program that she's doing at the moment and has been doing for quite some time. And then we'll run into some questions as well. So just bear with me while we get rid of this video. Our heads off the chat box by just clicking the arrow up in the top right-hand corner, and that'll just make the presentation a bit bigger. So Tam, we might, if you like. Yeah. Enough talking for me for a moment. So do you want to start with the business stuff?
Yeah, sounds good. So an extension from last year's original budget is the full asset write-off. So that was being extended now out to 2023 if your business turnover is under $5 billion. So what's going to affect most small business entities is if they're in pooling, the whole pool will be written off this year. So it will create a really big tax benefit this year, but we want to go through in the next kind of slide some of the future implications that we see as accountants, having dealt with this for a little bit of time, happening in the future. So there's lots and lots of things that we need to kind of think about when we're doing the 2021 tax. So we'll be going through that. And I just want to, I suppose, mention it's not all assets that fall under this. There is still the luxury car tax limits that will cap, bigger vehicle purchases, and building or land improvements also won't fall under this. So I just wanted to kind of point out that it's not all assets that will, I suppose, carry on with that.
The other one with that too is, of course, the and that $5 billion. It's fair to say most small to mediums are going to fall under that turnover threshold, but the 50 mil, there's a 50 mil threshold as well. And again, most will fall under that, and that allows for new or second-hand purchase of assets. So it doesn't have to be new assets; it can be second-hand purchases of assets as well.
Yeah. So then there's the loss carry carry back rules that are also extended to 2023, which means that you can offset a current year loss off against prior year tax that you've paid. It's going to go really hand in hand with the asset write-off, because if the asset write-off is going to create a big loss now, then you'll get an extra refundable tax offset there. So that's something that's, again, been extended, nothing new. We were dealing with this last year as well. Super guarantee. So this is a little one that's come into place that I see, I suppose, a few little housekeeping from business issues happening with this. So the lower income limit of $450 has been removed. So it will affect a lot of casual employees, those employees that might work 1 day a week, or you know, one shift a week or something like that. It is also not expected to come into place until the 1st of July 2022 at this point in time. So
we should say that there's some of those things here that whilst they've been announced, that broadly the announcement is that they will come into play the financial year after they reach royal assent, and the feeling is that that won't happen until after the 30th of June. Now the government probably wouldn't have said that if they didn't plan to put it in until well, they were planning to put it in from July 2022. But it's a bit of a sneaky one, particularly, and we'll cover off the childcare one shortly. Yeah. But it's a bit of a there's a bit of a sneaky thing. Yeah.
I think in practice, this is going to catch a lot of employees that kind of might have a trial and haven't necessarily given the employer back their documentation, because we all know when we put new employees on, they kind of come, they start, we may then, you know, give them their tax file number declaration form and the super choice form, then they'll, you know, return that, you know, the next day or a couple of days later. However, if someone doesn't work out and they only do 1 or 2 shifts, they're still going to have super liable, but you actually may not know what their details are. So that's going to be a little bit difficult from an employer perspective, and we just need to be making sure that employers are really crossing the T's and dotting the I's in terms of the compliance paperwork pre them starting, and I think that's going to be really important for this.
Absolutely, and I think the other thing to mention here, and it's something that wasn't, Tam and I were talking about it yesterday because it wasn't mentioned in the budget, but there is currently a 30-hour per week test in place for people under the age of 18 working in businesses. So they need to have worked for 30 hours or more a week in a week to actually be required to pay super for them. That presumably there's no mention of that in the budget, so we're assuming that's going to remain in place. So for casual workers or for kids with jobs after school and that sort of thing, that they're not going to be impacted by that change. It's probably more, as Tam said, the ones that are working one shift or 1 day a week or something and earning a lower amount of money, they will now get paid super on that full amount. So it makes sense, but as Tam said, it does come with some administration challenges. And also, we were also talking about before the fact that the government is trying to get people to have all their super consolidated, and it makes good sense to do that a lot of the time. And in fact, what this may do is actually create more superannuation accounts for people, because the employer is going to be required to pay the super regardless, and if they don't have super details, well, they'll just have to put it into a fund, into a selected fund. So it may actually require or create more of an issue there. But anyway, it's a good idea, but I think it's just got those, just like any good idea, they've all got a little bit of a downside. And as we said, we think that's not going to take place until 1st of July 2022 at this stage.
Yeah. The apprenticeship commencements program has been extended for any new apprentices and trainees hired before the 31st of March 22, which allows 50% of wages for those employees to be reimbursed at the end of every quarter for a cap of up to $7,000 per employee. So this is a really good initiative. I've got quite a few clients on this one that, you know, get quite a lot of money back for hiring apprentices. So this is a really good one, and I'm kind of glad that they've extended it. And the job trainer is another one that they've extended to the end of next financial year, which is for job seekers, school leavers, those types of things. I just haven't really seen many people actually taking that one up in practice. I think, and the government did say the other night that they were thinking that that job trainer would have gone, you know, really nuts, and a lot of people would have been taking it up, but they were very surprised that it's had a low take up. And I think that's just generally because, yeah, people have more been going down the apprenticeship line.
And it's like the job maker one as well. So it's a difficult criteria. Whilst it's good in practice, that I don't know if we cover off job maker. I don't think we do specifically, but job maker is a good idea in theory. In that, if you're extending your workforce and growing your workforce and your headcount, that you get some sort of rebate for that. But in practice, and the things that you need to the criteria that you need to meet for those employees, it's actually very difficult to find employees that meet those criteria. So whilst you're employing people and you may be growing your headcount, I've had very few people that are going to be eligible for job maker.
Absolutely.
So just going to cover off on a quick example. And this is the sting in the tail that we were talking about, and just being aware of these immediate write-off rules for assets. And whilst it creates a great tax benefit in this year, we've just got to be mindful of what happens down the track, because really depreciation, when you think about it, is just basically expensing that asset generally over the period of time that you're using it for. Small businesses have the ability to bring it forward a little bit further, but certainly not normally writing the whole lot of it up front, and certainly absolutely not no matter what the value. So just an example here, we've got a company, just so we can use a nice easy tax rate, standard tax rate. They purchased a ute for $50,000. Let's just say they've done that before 30 June this year. Assuming a tax rate of 26%, they had a profit of 100,000, so it's reduced that profit by 50,000. They get a direct deduction for that, and it'll result in a tax saving of $13,000. So you can look at the net cost of the vehicle as being 50 minus the 13. It basically saves them $13,000 in income tax. So really good. It's great. So that's the whole point of it. Well, that looks great. All of a sudden, that if the vehicles, you're paying 37 for a vehicle as opposed to 50, it's a bit more attractive to go and buy it. So that's the whole point of it, is to stimulate purchase. Now, the issue with that is if we then sell that previous ute in August 2023. So the new measures have extended the temporary asset immediate write-off to 30 June 2023. Now, if we sell that after that date for $30,000 and replace it with another ute, and again, assuming it's $50,000, now the tax rate will have changed in the companies by that date. We're assuming it's 25% because that's what's legislated at the moment. Tax implications that when they sell that ute, they're essentially having to give back $7,500 of that 30 because they've got no cost base associated with it. They've claimed it all up front, so they've got that immediate tax benefit. When you sell it, you give some of that money back. Tax implications on the purchase are assuming they're using simplified depreciation. So this is the other thing, and this is why we've picked August 2023. And again, it's probably a likely scenario if you're buying a ute now and you're turning them over every couple of years that this is the sort of thing that might happen. That they're going to be, because that 30 June 2023 date is the last date for immediate write-off at this point, they're actually going to go back under the old simplified rules if they're using those rules or just general depreciation rules. Either way, they're not going to get that full $50,000 deduction under the current rules. So that gives a $7,500 depreciation tax deduction, which is just 15% of the 50. Tax saving on that is only roughly $2,000. So in fact, they're out of pocket in tax, $5,500, $5,625 in tax on that changeover. Now, this is not the end of the world. It's not an enormous amount of money, but when you're not expecting it, it can be a bit of a sting in the tail. And we've also put a point there that the bigger the cost of the asset, the greater the out-of-pocket tax liability. So, and this is the danger, well, it's not the danger, but it's just thing to be aware of, is that because there's no cap on this immediate asset write-off, you're going to remove all your pool, as Tam said. So if you're in pooling and you've got a general pool there that we're writing off gradually, all that's going to be gone. So that creates a great tax deduction this year, but it just means there's nothing to offset that sale price. So the bigger the cost of the asset, so that you can be buying headers, you can be buying things worth hundreds and hundreds of thousands of dollars. And so when you're talking about changeover prices and those sort of things, that can be significant. So just be aware of that. It doesn't mean you shouldn't go and do it. Of course, the point of it is that they're wanting you to go and spend the money and buy the assets, but just be aware of what it means down the track. The other thing we've noted there is that we'll be more than aware of the fact in June 2023, assuming they don't move that forward another 12 months, or depending on what happens, I suppose, over the next little while. But if they did that change over in June 2023, they'd actually have a net tax benefit of 5 as opposed to being out of pocket 5. So it's actually a 10 grand tax turnaround there. Now, we should also note there, they're just kicking the can down the road again further there, because you obviously then when you sell that ute that you've immediately written off, that there's issues down the track. But just the timing and I suppose the cash flow benefit of that, it's just worth being aware of that.
Absolutely. I think that's going to be the biggest thing, is that the timing of all of these things in the next couple of years is going to be the most important thing to be, I suppose, communicating with your advisors, to be really explaining what you're wanting to do within your business. And I think that, and that's why I suppose our job, we're going to be absolutely earning our money this year, because we are going to have to really weigh up whether, if you're in a small business pool, if we keep you in the pool, if we do automatically write these assets off, or if we elect to go out, and how we're going to be treating them going forward, and really discussing these tax implications on a one-on-one level with you. So I think, that's going to be a really big thing for us this year, is to really more plan and talk to you guys long term about where you're going in your business, so then we can help plan and hopefully try and step some of these out, so that particularly those really, really bigger purchases, you're not going to be absolutely stung down the track.
Yeah, that's right. Because I think we always have that, and I think we're all pretty well the same. You have that immediate stars in the eyes sort of reaction to getting a massive tax deduction. You think, how good's this? That's great. I don't have a tax bill this year, or I get some back, or whatever it might be. But we sort of forget that there's some things to consider down the track. As Tam mentioned there, and just touched on briefly, we're still not clear just on how these things interact, and the ability for small business pool or simplified depreciation participants, which a lot of our clients are, and a lot of small businesses are, the ability to opt out of temporary asset purchasing if you're already using pooling. So there'll be some things come out about that, I think, to make it clearer over the next little while. There's some stuff on the ATO website that contradicts itself a little bit. So it's a little bit confusing as to what's going to happen there. But obviously, if you're buying the assets and it's already done, well, that'll just be a technical thing when we get to that point in time. But as Tam said, that these rules on immediate asset write-off have been a nightmare for tax practitioners over the past probably 3 or 4 years, because they've changed so many times. Like the tables the ATO are producing around what we can and can't claim, and the timing and all that sort of stuff. And when you buy the assets, very difficult. One other thing we should say with this is that in order to be eligible, and this is probably in line with the fact that how long things are taking to get to Australia at the moment, just with supply chain issues and manufacturing challenges and all that sort of thing, is that in order to be able to claim a tax deduction for an asset, it needs to be installed and being used or ready for use. So you can't technically pay a deposit or pay an amount for an asset, have it come in, say August in 2021, and claim it this year. It's got to be when it's on the ground. So you will be able to claim it next year, because again, it's an extended thing. But just be mindful of that. Particularly, we're talking to clients about it at the moment. They're telling us, vehicles are going to take 3, 4, 5, 6 months to get here. So,
and the dealers aren't even invoicing or accepting deposits at the moment because of it, and because everything's in such short supply, and until they actually physically receive it themselves, they can't even start invoicing it out. So, it's just a little bit crazy trying to buy assets at the moment.
Yep. Definitely. Okay, moving on to this tax offset, this low and middle income tax offset. This is the one that the government spoke last year about giving us $1,000 extra out of your tax, and they've actually extended that further. And again, that's further extended to 2023. So basically, that just it delivers a tax cut, a temporary tax cut, and gets us through until the tax changes, the next tranche of tax changes. And obviously that's a welcome thing, because it's the thresholds are there, but anywhere between that 24 and up to 90,000 per person, you're getting a tax offset of about $1,000, which really basically means translates to $1,000 in your pocket, in your tax refund. Now, obviously, you don't get that until you lodge your tax return, which is also, again, just trying to encourage compliance and lodging returns as quickly as possible. I don't think there's anything else on that, is there? No.
a little bit different to the old Kevin 07 tax refund.
Yeah, that's right.
Tax refunds that we were getting.
Yeah.
It definitely is a compliance-based one.
Okay.
All right. So,
sneaky.
oh yeah. So the increased childcare subsidies. I was a little bit excited about this listening to the budget the other night. I thought, oh, this might actually benefit me because I've got 2 in childcare at the moment and 1 at school. And then the next day, the dates actually come out, and this doesn't come into effect until the 1st of July, 2022. And it is for families that have 1 or more children aged 5 and under in childcare. So they'll get a benefit of up to 2,200.
Well, the subsidy's been increased to 95%.
Yeah.
And the cap has been just taken off altogether.
So the 10,560 cap's been removed. So I think initially that was a really good measure that was announced, but the practicalities of that not coming into place until the 1st of July 2022 is a little bit disappointing.
Yeah, and the Prime Minister and the Treasurer have copped a bit of a smack about that over the last few days because they weren't terribly clear about those dates. But and that's right, and it's been criticised for being fairly targeted, I suppose, as far as obviously single child families. It doesn't help at all. And it's clear as to what the government's trying to do there. Yeah, their research has shown essentially that mums are going back to work and working for nothing pretty well, because by the time you pay for the childcare and you're out of pockets, you're really just going to work as a recreational activity, which is not fair, and doesn't encourage women to get back into the workforce at all. So, and that's the number one reason for it. It would have been great my personal view on that would have been great to see that open to any family in childcare, as opposed to just having multiple kids.
Absolutely. The new home guarantee has been extended for 10,000 additional places, and that allows single parents to be able to purchase a home with only a 2% deposit, which means no lender's mortgage insurance on that one.
And that can be significant. Just to give you an idea, depending on how much you're spending on a house, LMI at a level where you've got that level of deposit could be anywhere between $5,000 and $15,000. So it's a significant amount of money. So that's a big, and obviously that at that level of money, if you're in a single parent or you're in a single earning capacity, that amount of money can make be a real barrier between buying it, because you've often got to pay that, generally speaking, up front. So it can be a real barrier for people to get into buying a property. So that's welcomed. That's excellent. And that can be, there's a couple of things that can be new and existing
homes. Yeah.
And it doesn't need to be new. It doesn't need to be first home either, I don't think.
No, it doesn't. No, it can be for another home, like a second home, or not a second home, but if you're changing over or something like that, or potentially if you've separated and you've gone from a single, from a couple to now being a single parent, that would probably be a really welcome measure in that circumstance. And you may have been a homeowner in the past, but not now. Sorry. Then the first home loan deposit scheme is again extended for another 10,000 places until 30 June 2022. Now this again is initially it kind of said that it was for new homes, off the plan homes, that house and land packages. Yep. However, we've done a little bit more research, and it does include existing homes as well. And that's for first home, that has to be first home buyers, with the deposit of as little as 5%, which is, really good.
And again, it does the same thing. It just basically guarantees it up to the 20%. Yeah. So it doesn't mean the government's tipping in the 15%. It just means they guarantee it so that you don't have the LMI on the purchase. So the same level of saving there on that. There are some income tests around some of those things. Obviously, it's got to be, and also some tests around when you've got to move into the property and all those sort of things. So have a look at that. But if you're looking at your first home, it's worth having a look at, and worth applying for potentially if you fit those criteria.
Absolutely. Another little one for personal tax offsets is there was a limit of $250 for if you've paid self-education expenses out of your pocket, and they've just removed that to make it easier for you to claim a tax deduction for it. So what that meant is that the first $250 you couldn't claim a tax deduction for, anything over and above that you could, so now you can claim a tax deduction for the full lot. It's not expected again until the 1st of July 2022 though.
So not a major one there, but it just, I suppose, it makes it a little bit easier. I suppose what they're doing is trying to encourage a bit more self-education or to reward that if people are changing jobs or have had to shift from the events of last year.
Yeah. Now I wanted to pop in here this time around something that I've been speaking to a lot of my clients on is that the super guarantee is increasing from the current 9.5% limit to the 10% from 1st of July. And it will then keep increasing 0.5% every year and it reaches 12% in 2025. So why I've been speaking to my clients particularly about this is that come, around that end of financial year, we generally encourage, employee performance reviews and that type of thing, and you'd be considering pay rises, but they're essentially getting this 0.5% of a pay rise already. That I'm just trying to urge people to take that into consideration and talk to their employees about that, because it's one of those things that super's usually an afterthought. It's usually here's your salary package and then that super's on top of it, but I think it's really important that you use that as a bit of a bargaining tool, I suppose, for the end of financial year. And the lower income limit has been removed for employees who earn less than the $450, which we went through before, which is more going to catch those casual employees.
Yeah. And whilst that, the 9.5% to 10% is 0.5%, it could be a significant amount if you're depending on what your wage bill is, because it's a mandated increase. They're not going to. It's not like you can say, well, we're going to reduce your employee wages by 0.5%, increase your super. That's not the way it works, obviously. So it's going to increase, and as Tam said, it's work well-being, and it's going to continue to do that, as you said. Like it's and it's a great thing. Like it is a good thing, I suppose, for the general populace that we're going to have more going into super, but it does directly increase expenses for employers. So just being mindful of that for new employees as well when they're coming on board. But you are going to be paying them more.
Absolutely. And I think employees forget how much, because they don't see super, they actually forget that it's going in there. So they don't see the value in that, but it's still a really big cost to the business. And I think it needs to be really communicated well that is a cost and it is increasing and we're putting this much into your super every year. So, don't ask for as much money. So the superannuation work test for older Australians aged 67 to 74 has been removed for non-concessional and salary sacrifice contributions. So this still applies for concessional contributions, but just not the non-concessional and salary sacrifice. So on initially, this sounded like a fairly good idea, but sole traders and people in partnerships that can't salary sacrifice, this isn't really going to benefit them. So it's more for, I suppose, people in a trust or a company that, pay themselves a wage and can potentially salary sacrifice deductible super in that way. Yeah,
that's right. And it's still, I suppose, the other thing too is if you are in business and you meet that, but if you're in business, you're probably going to meet the work test. So even for the other ones, for the concessional contributions, you're still going to meet that work test, because it's quite an easy test to meet, particularly if you're working, even half time. You're going to meet that test. So it just removes a bit of a barrier for people to get more money in super. Again, they're just trying to encourage people to save for retirement. That's the whole purpose there. And that work test, generally speaking, just holds back a few people from putting more money into superannuation.
And then the downsizing home contributions has the age limit has decreased from 65 to 60 years. So that's for people that are looking to downsize their home. They can now contribute up to $300,000 or and that's per individual. So $600,000
Excuse me.
can go into superannuation for the couple. However, it does have to have been the main residence, and it does have to have been owned for 10 years when you sell that. And then you also have to be, I suppose, downsizing and buying another property as well. That was another requirement there. But that is a really good thing for retirees that are potentially going from a family home into a unit or something like that. They can contribute, you know, if they didn't have a mortgage or anything in their family home, they can put a massive big chunk in, and that's not going to, you know, go towards their yearly caps and things like that. So that's right. A good thing.
That's it. That's the important thing, is it's outside of all those caps, and we know that, you know, generally speaking, if you're downsizing, it's probably, you know, it tends to line up roughly with when you're going to retire anyway. So it's a good time to get money into super. We know that superannuation is a great tax environment for earning income and for I suppose for retirement income, and it will always be that. And there's always concern about government mucking around with super and taxing it more and all those sort of things, and they probably will do that because it is pretty generous. But regardless, it will always be the most tax effective, in my opinion. I think it will always be the most tax effective environment because it has to be. The government want us to be able to retire independently and without their assistance in time, and if they want that to happen, they need to provide as much incentive to get money into super as you possibly can, and the best way to do that is to give really good tax concessions around it. So that's why that's there.
And it's a good way for people to capitalise on the real estate bubble that we've got going on at the moment. Absolutely. As well, selling while the market's at a high, and then, you know, downsizing to a smaller property. So that's definitely going to, I think, benefit a lot of people over 60.
Absolutely, and it's it's good that it's come back from 65 to 60 because obviously there's people retiring at 60 and downsizing. So it's that makes sense, and it just opens it up. I get a feeling that there's probably not as many people using that as what the government thought there might have been, and therefore they've opened that up a little bit more. It's to be a little bit more generous with it. Again, this one is another one of these sneaky 1 July 2022 ones. So again, these dates will be confirmed, and if the Royal Ascent happens before 30 June, well, maybe next year, but by the look of it, that may actually not happen until 1 July 2022.
Yeah, real estate bubble probably will be best.
Well, who knows? Who knows? It's hard to tell.
Yeah.
Okay. Just a general one too. This isn't to do with the budget, but it's, I suppose, just a bit of awareness. This was slated to happen regardless, but it is handy for clients in business. So concessional cap. So this is the amount we can put into superannuation individually per annum and get a tax deduction for it. It includes both personal contributions for just personal concessional contributions. It includes SGC, so that your employer contributions, and it includes salary sacrifice contributions as well. All of those have to be under 25,000 for this financial year. That's lifted into 27,500. It's been indexed to 27,500, and then the non-concessional one, which is again the opposite. So the one you're doing after tax, so you're putting in money that you already paid tax on. You don't get a tax benefit from putting it in there. That's increased from 100 to 110 per person. We've also got some things around bring forward rules with concessional contributions and things like that now that are there and available if we want to use them. We won't go into too much detail about those, but they're pretty generous as well as far as I suppose being able to roll forward and use caps from previous years that you haven't utilised, and can create a really good tax benefit.
Yeah.
Particularly for people who are getting out of business or selling or having a really big income year, you can, I suppose, rather than losing your cap, you can roll it forward and get a benefit. Yeah. I think that's about it on that one.
Yeah. Okay, so the ATO debt recovery. So again, initially, when they first announced this the other night, they weren't very clear on exactly what it was. But this isn't going to benefit many people. So all that this is saying is that if you've got a dispute with the tax office over a debt, that they can put that recovery action on hold until the case has been decided on. So initially it kind of more was spoken about in general terms, like general debt. So if you've got like a income tax debt or a BAS liability or something like that, that they wouldn't be chasing you for that, but unfortunately that's not the case. This is more for probably very specific debts that are being disputed, more so like an audit or an ATO self-assessment or something like that that's going to be disputed, that it then the recovery action can be put on hold until the case is decided on.
Yeah, it's right. It's really the ATO not being. It gives the client the ability to stop the ATO from essentially winding them up, or to commence it, or to take collection action too far if there's a case in the courts or in the AAT that is disputing the fact whether they owe the tax or not, which is fair. That makes good sense. I think, like, if there's still a dispute and it's going through a process, well, in my mind, the ATO shouldn't be able to collect that debt until that's been decided. So I think that's a reasonable measure. But as Tab said, maybe not what we thought it would be. While we're on this, just being mindful that a measure that was brought in 12 or 18 months ago now, around the credit rating and ATO debt affecting your credit rating. So just be mindful that whilst at times businesses, it's quite normal for businesses to have debt with the ATO, and sometimes for an extended period of time. We try to avoid it, but it can happen. Just be mindful that there is an impact now on your credit rating. It will potentially an impact on your credit rating with ATO debt. There didn't used to be, but there is now. So banks will always ask us for portal reports and running balance accounts and all those sort of things if you ever go for finance. It's just a standard thing now. And that will impact an application, but it will also impact a credit rating, and even if you're not applying for things. So just be mindful of that. We all know we're trying to avoid the debt and it's sitting there anyway. We don't want that. All right. We just thought we'd briefly, as I said, discuss tax planning. This is a time of year where we can still do some things, I suppose, that will impact the tax result for the 2021 financial year, and that's more around. We've discussed some of the things in the presentation. So superannuation, obviously asset purchases is a big one this year.
Bringing forward expenses.
Yeah, bringing forward expenses and some more specific ones for primary production in farm management deposits and that sort of stuff as well. I think it's important just to understand a couple of things about this. One is that just because you haven't got the money in the bank, and I think we've all experienced this, doesn't mean that you haven't got a profit. So just be mindful of that, and at minimum be reviewing your results in your accounting program and just seeing where that's sitting, because quite often with accruals, so with debtors and creditors and those sort of things, we can feel maybe like we haven't made a profit, but in fact there is one there. And selling of assets and those sort of things as well, that can cause a bit of an unexpected tax bill. So just be mindful of that. The other one too is that, which we're big ones on, is of course you don't spend money for the sake of saving tax. You really only do things that you were going to do anyway, or that you were considering to do, and you may just change the timing of those things. And that's really what these immediate asset things are designed to do. And with the write-offs is, if you're thinking about doing it in the next few years, you're probably going to bring it forward and get it done, because you're going to get that tax benefit. But you're always better to keep $1 than to spend it and save 30 cents. So it's just being mindful of that, because none of us like paying tax. It's a bit of, I haven't come across anyone that does anyway. So it's an annoying thing to do, but you're much better off having the money in the bank than trying to spend it just to save tax.
Absolutely. And I think it's just really important from a business owner's perspective to kind of know where you're tracking coming into here as well, and what money you need to keep aside or have or keep putting aside to plan for that potential tax bill if you do have one. I know the phrase always sticks with me: if you fail to plan, you plan to fail. And I think that's something that I encourage my clients to, is just know where you're at, so then you just know, you can get the peace of mind yourself.
Yeah, absolutely. One last thing on this is that you don't have to have a bumper year or a great profit year in order to get a benefit from tax planning. If you've had a really classic example, if you've had a poor year on a farm and you've got money in a farm management deposit, it may actually be a good year to pull that money out to level the tax implications of doing those sort of things. And there's various things that where that might apply. So just be mindful that even if you haven't had a great year, there's still some things that can possibly be done between now and the end of June to make sure we maximise the position for you.
Yeah. Beautiful.
So we will have been in touch with you about that. But if you have any questions around it and you haven't engaged us or you're not talking to us about it, please feel free to reach out and talk to us. More than happy to discuss that. All right, now we're going to move on to your thing, Tam.
Hello, good looking. No, so we've been running the business mentoring program for a little bit now. We've done well, it says 30 businesses there. I didn't really spell check that. It's 45 now thus far, which is absolutely amazing from a program that we developed and got off the ground 8 months ago. It's amazing to have worked with that many businesses around this, and I suppose the main focus is empowering the the business owner to really know where they're at with their business, increasing their profitability, and giving them the knowledge from their accounting package and those types of things to be able to make important business decisions and plan for where they are now and where they want to go in the future. So it's been an absolutely amazing program to have got off the ground. So yeah, if you want to know anything more, then get in contact with us. I think whoever your advisor is in PTP will be able to help you out or give you my number or whatever works.
Well, and real credit to you, Tam, for what you've been able to achieve there. Like, I love that saying at the end there, run the business and create the business you've always dreamed of. Really links in well with our mantra, creating dreams worth fighting for.
Absolutely.
And I think you really are making a massive difference for a lot of people, and the feedback we're getting from this program has been unbelievable and overwhelming with the benefits that clients are getting from it, and just understanding. I think and you've said there that you've worked obviously in practice. You've worked in a family business. You've run your own business. You've got all the. I suppose you cover all the aspects of understanding. I suppose both sides of the fence, and understanding the practicalities of what is going to impact a business and what you can do really day to day to make a real difference. So. It's fantastic, and I suppose on behalf of PTP and their client base, and everyone, thank you very much for what you've done, because it's very exciting.
It is, yeah. So get in contact if you need help in that area.
Excellent. All right, we're pretty well bang on time. We're probably a couple of minutes in front of where we wanted to be. We wanted to allow 10 minutes or so for questions. Just before we move on to that, we might just cover off just really briefly on some of the things that are were probably not so relevant or going to be as applicable to as many businesses in the budget as some of the things we've already covered off on. But they are there nonetheless, so we'll just mention them. One is some concessional taxing around patents, and that's more around the medical and biotech patents, and that's basically what that means is you've got a patent, you're making money off it, you tax at a concessional rate on those, which is obviously in line with the spending in the health sector, and encouraging people to get in and spend some money in that space. There's a digital games tax offset, so that's more around, I suppose, developing games and apps and that sort of stuff, and that's obviously a growing area.
Yeah, there's also the small distilleries one as well.
Yep.
Again, we didn't,
distilled whiskey and
small wineries and things like that. So yeah, some of those little things that we didn't really necessarily need to cover off on today, because I don't think they're going to affect the bulk of businesses. We kind of just tried to do like a very general spiel.
Yeah, absolutely. The only other one is the changes to the employee share schemes. Now, this is generally speaking a more corporatised model where for bigger businesses, but what they're trying to do is make it a little bit more accessible for smaller businesses. And what it involves is basically employees, as it sounds, having equity in the business. And they've just made it a bit simpler in order for that to happen, and also removed a bit of a kink in the system that created a bit of an issue around taxing. So they've just removed that, removed the cessation of employment as a condition of a taxing event. So that's one to be aware of if you're thinking about bringing some employees in with equity. in your business, and it's just made that a little bit more straightforward. Which, yeah, if you're growing your business or for succession planning, that may be something that you're thinking about. So just keep that in mind. All right, we'll open it up to questions. We'll just see if we have any. Oh, I've got some. Excellent. Okay. So we'll put it up on the screen. Thanks, Paul, for your question. I have a trainee who started in October 2020. He pays tax and super, but he's from New Zealand. He's a resident but not a citizen. Under the apprenticeship scheme, he doesn't qualify, but might he qualify under the trainee scheme or some other scheme? Good question, Paul. We've got our notes here. We'll just have a bit of a look.
Generally speaking, they do have to be residents of Australia to qualify for any of those types of things. It doesn't actually specifically say. So, Paul, we might have a bit of a research into that one and get back to you. But as I said, generally speaking, they do have to be residents, which is a little bit annoying.
Yep.
But yeah, we'll definitely look into that one.
Which is, yeah, it's understandable, but for people that are going to remain here that are, going to be citizens probably in the future but aren't quite yet, it can be a little bit difficult to accept that. But yeah, I think as Tam said, we'll come back to you, Paul. We'll take that on and answer that for you.
Yeah.
Now, Sharon, I think you've asked a question in two parts, because I think I saw down here somewhere about the superannuation increase.
Yeah. Is that the 9.5 to 10%? That will take effect, Sharon, from the 1st of July 2021, so only a month and a half away. It will increase to 10%, and then every year after that by 5% until it reaches 12%. So that's a nearly immediate, one coming into effect. And that's been, legislated for a little while now, but it has just kind of, it's just sneaking up on us. And it hasn't been
at 9.5 for a couple of years.
Yeah, and it just hasn't been very heavily publicised. I think that's why we really wanted to bring it up today, and I've been trying to get it out there as much as I can in terms of, it is one of those ones that just isn't out there very much, but it's going to affect everyone. And potentially it could go unnoticed, because a lot of the single touch payroll programs will automatically just do it from 1st of July. And, if you're not really, if you're very busy and not really looking at all of those little things, that, you can have that extra 0.5% of an increase and not really worry about, not really know about it. So,
just one thing we should mention while we're talking about super, just as a general message, is that the ATO is now more than ever aware of what our super liability is with single touch payroll. It's one of the reasons they've implemented it. And we do have, just a reminder, we do have that requirement to pay superannuation to our employees before the 28th of the month following the end of the quarter. So any later than that, and there's the process you've got to go through to then lodge that. Further, that if you've paid super late but you have paid it, and you have assumed that that's going to be fine, and that you sort of moved on, just be aware that the ATO can go back and have a look at that. So you're better off, in reality, going back and completing the process that you need to do to, I suppose, close that loop. And minimise any risk, because the penalties can be pretty severe around that.
Absolutely. And I think just also wanting to explain that you don't have to wait to the end of the quarter. If cash flow, I've got clients that pay it weekly. As soon as they finish their pay, they just pay it straight to the super clearinghouse, or pay it at the end of a month, or they're putting their money aside in their GST tax and super account, so that they've got their money, there for the end of the quarter. But it doesn't have to wait until the end of the quarter if you don't want it to. So I think that's something that I don't think it's, ever really spoken about. But, if you prefer to pay it earlier, or, weekly or fortnightly, whenever the pay run ends, that you can do that.
Well, it's much simpler now, isn't it? That's the reason why people.
Xero, a lot of the Xero Mile QuickBooks, when you're doing, if you've got it integrated with the superannuation super clearinghouse, you literally just select, tick the boxes, lodge it, authorize it, and it automatically deducts from your bank account. So it's so easy now these days compared to, I know when I started, we were writing out checks, filling out manual forms and mailing them off.
That's right. And that's why it made sense to do it once a quarter.
Yeah, yeah.
But now, with how automated it is, it's pretty easy.
Yeah.
And as you say, that can sneak up too, like as in just the level of it and the size. So, Judith, thank you for your question. Downsizing, does the contribution occur the 15% tax rate going into super? My understanding, look, and I'm not a super expert here, but my understanding is no, it's a non-concessional contribution. It's outside of the caps. So pretty well, if you put 300 in, you're going to keep 300 in your super. Is that your understanding?
Absolutely.
Yep.
Yeah. It is outside of the caps. It's not going in as a concessional contribution. It's going in as the special downsizing contribution. And that, I don't believe it gets any tax in there. It's purely, you're not going to be claiming a tax deduction for it, so it shouldn't affect tax in the super funds. And it's an initiative to get more more contributions into super.
Yeah. That's good, Judith. You can put as much in, and there's no tax being taken out of there.
And just again on that is the downsizing. It's $300 per individual. So if
300,000.
300,000. So you can potentially get up to 600,000 in for a couple. So that's definitely really beneficial.
Yeah, absolutely. A couple other questions here. Debbie, thank you for your question. Get that up. Under the first home saver scheme, there is some changes to the first home saver scheme which we didn't cover off on. If I paid 10,000 voluntary super this financial year, can I withdraw that plus previous voluntary contributions next financial year towards my first home purchase? I have already paid a deposit on and off the plan. Tam's excited here because she's got this in her notes somewhere.
Yes, I did. Here we go.
Can I withdraw that plus previous?
Yeah, you can. And it's not written here, so I'll get back to you, Debbie. It might actually be in the NTAA one. But yes, it's up to a limit. I believe it's 30,000.
I think it's increased.
Kind of increased to 35.
Under the maximum releasable amount of voluntary contributions from 30 up to 50.
Up to 50. There you go.
So voluntary contributions made from 1 July 2017 up to the existing limit of 15,000 per year will count towards the total amount able to be released. This change will apply. Again, this is a 1 July 2022 sneaky. So that limit will still be 30 by the sound of it from for the previous for the next financial year. Will increase to 50 following that.
Yeah. So I think, Debbie, would have to look into, given that you've already paid a deposit off the plan, your house is going to be built before you're able to actually access that out of super. So you might just have to have a bit more of a look into that one.
Yep. Happy to talk to you further offline, Debbie, just to get into the detail on that one. Okay, and Sharon, thank you. Another question here. In regard to the asset expensing, if it's installed by end of financial year 2021, did you say this was being extended? Yes, so if it's installed ready for use before the 30th of June 2021 and you paid for it, obviously, because that's generally the case, you don't get it unless you paid for it, you'll be able to expense the full amount of it up to an unlimited amount in this current financial year, in the 2021 financial year. If, however, you pay for it and it's not delivered and it's not ready for use, and that might happen in July or August or so some stage, 6 months down the track, it will be deductible in next financial year.
And still fully, it will still be fully written off because it'll fall still before 30 June 2023.
That's right.
But it's more so, if you're putting a deposit down on a vehicle or, like an irrigation system we were talking about with a client yesterday, something like that you're paying a deposit on, but it's not going to be installed until next year. That's kind of what will affect there. But if it's fully expensed and installed, no problems there.
Yep. Hopefully that answered your question, Sharon. And thank you. Thanks everyone to have the questions there. Debbie and also Paul will follow you up following this, just to make sure that we're able to cover off on your quick questions there. Just so we can get you out of here in the next sort of minute or so. Thank you very, very much for coming along. Again, thanks so much to Tam and to Amy for putting this together. Really appreciate the effort, because it does take a bit of time for everyone to get these things together. Thanks to everyone who's made the effort to come along. For those who are going to watch it afterwards as well, hopefully get some value from that. Please don't hesitate to yell out. We'll provide any updates on these things as they get clearer on our Facebook page, so keep an eye out for that. And other than that, I think have a great weekend. Enjoy the rest of the week.
Absolutely.
All right.
See you guys.
See ya.